it's like to get on the newsletters. Um, what
Well,
is it, Scott?
the best way to follow me is to show up on Fridays right now. When I'm on, that's the best way to get some stuff. Um, I will have some links for you by the next time, but right now I save all of my favorite stuff for talking to you.
There you go. Oh, so special. But you also write, I see you like on Trading Pub
Yes.
and Prosperity Pub.
Yes.
Is that it? So both
Yes.
of those places I think are
Yes.
great. And
I
then,
do that.
yes, Jack, what's a great way for people just to follow you and get some of your content?
JackCarterTrading.com.
There you go. We'll try to get some of those typed in, Adam or anybody that can help out. So yeah, love listening to Jack and some of his stories. He brings in the wild. Sometimes it's really good. And then Garrett just typed in. So Garrett, go ahead. And what's the best way?
I mean, I write the Trading Pub. So today we have a column coming out on oil tanking stocks. So that's one way to follow me. I talk about momentum every day in that, but one of the other initiatives that I'm launching is called the Florida Republic. So floridarepublic.substack.com. It's listed above, and I go into about 1,300 words a day on that. So it's a lot of in-depth analysis, and it's free because I'm just such a nice guy.
You are. We got a lot of nice guys here today. Yeah, I've seen some of that. It's really fantastic. Really, all of you guys. Well, we're going to get started here today. Welcome here to Ask the Pros. We're glad to be here with you. Each week, we try to bring ideas, thoughts, processes, the way we're looking at the markets in a way to help give you an edge in the way that you look at markets. But there's no guarantees. When you trade, you can lose money. If you trade options, you can lose a lot of money. You want to make sure that you understand what you're trading before you ever click that mouse. And we can go through some of those setups as well. So with that, let's jump in. Let's get started. The topic of the day is, this longer term investing. Exactly what is it? How long is a long-term investment? Is it even something that we should even do? How do we go about do that? What is this thing about growth stocks or value stocks and the dividend stocks? And is that a worthwhile thing to add to our arsenal of trading? How do we do that? So I just brought up this article, told everybody we'd kind of talk about this as just as a starting point. Not that it was anything super great, but this guy, Robert Johnson, is in Forbes, professor of finance at Creighton University, and says, hey, there's a place for this in everybody's portfolio. It's been great since 1929. But of course, if you invested in 2007 and put all your money in, you wouldn't have been feeling very good as a long-term investor at the bottom of 2009. So how do you kind of time these things? Let's have this conversation. Let's kind of go through these things. Garrett, you kind of, got my interest there a little bit on GE because, if you held on to GE from, there in October after it has some good news, innovative people there making a difference in the world. What is, do you keep holding that? If you're holding that long-term, do you keep holding? What's going on with GE, Garrett, from your perspective?
Well, so real quick, just on GE, and then we'll talk about the long-term perspective. Not a lot of people spend a lot of time reading a lot of the insane publications that I read, but I just read an article in Transformers magazine. There's a magazine dedicated entirely to the trade business of electricity transformers. There is a dangerous shortage of transformers in the United States. In fact, the lead times, which was usually 4 weeks, is now 52. And this is the type of situation that can cause a very significant blackout in a city if we cannot get parts, if we cannot fix our grid quickly. So the transformer focus, I think, is really significant because there's only about 6 or 7 companies that can really build these up to the industrial scale and meet the environmental standards that are being placed by the United States government. GE's one of them, ABB's one of them in Switzerland. I believe Emerson Electric's another one. That's an interesting trend. And, when you see these types of stories, that they're fascinating. And then what you do at that point is you start to drill down and you look at individual companies. And the way that we look at it, I still am an accolade of the Ben Graham view of the world, Joseph Piotrowski view of the world, where it's an 18 to 24 month horizon for value and for long-term investing. And that's kind of the basis of one of our portfolios for the Tactical Wealth Investor, which we just released our new pick today. A good Piotrowski score mixed with a low Graham score and just basically good fundamentals with a driver in businesses that matter, companies that make stuff. This type of portfolio structure has consistently beaten the market for 20 years since Piotrowski started writing about it. It's an element known as quantitative value. Wes Gray has written about this subject as well. It's very academic. It's heavily ignored by people, but it works because capital discipline among strong companies, good management mixed with low valuations and patience, eventually you start to see money rotate into those businesses after an 8 to 12 month period. And then from that point, they move from value stocks into momentum stocks. And General Electric was a perfect example of that since the onset of January.
Good. Great. Thanks for that. So let me move on to you, Jack Carter, because, you've come on, you've said, you're an investor. I know you are. The way that you approach things, you've enlightened us with, hey, when the market's pulling back, you can sell selling covered calls is a great strategy that you've shared with us and that you love. Let me ask you a couple questions just about your kind of investing a little bit. Like, for example, what's the longest you've ever held a particular stock? Do you know?
Oh, wow. Yeah, I know. Let's see, about 20, maybe 27 years.
Nice. 27 years. Do you recall what kind of a return, did you get off of that particular stock?
It's insane. I did two trades. I bought my son 7 shares of McDonald's for his 7th birthday, nice, which he still has, and it's split and it's paid him $1 billion in dividends. Yeah, so that's the longest, and that I did that to teach him about the market, because he liked McDonald's. He was 7 years old. He could see buying stuff and this and that, and just getting the feel for it. But yeah, that's a great. It's amazing if you become friends with time. It's amazing what a dividend stock can do for you.
I like what you said, friends with time, what a dividend stock can do for you. A lot of things that we can unpack there. So what about you, Scott? You've brought to us, this longer term view, the Weinstein kind of approach we're becoming more familiar with as you come here. What do you think are the advantages of investing over, just regular trading?
Well, for me, it's the drawdowns, right? The problem with trading problem with investing, or the great thing about investing, is that you hold it no matter what. Like, you have such resolute conviction that I'm just going to hold it. And I totally get that. And it absolutely works in stocks like McDonald's and Apple and Amazon and so forth. The problem for me, or people who are a little bit twitchy, who don't like waking up and seeing red, or don't like bad news stories, or don't like talking heads saying scary things on TV, it's tough to hold when you don't have a reason, right? And in trading and in athletics, I used to be a tennis coach, still kind of am, at least in my heart. But the problem is always the losing. It's not the long term or the fundamentals, or will it work in the end? A lot of people can pick the direction, but it's the losing, it's the drawdown. So for me, I like rules because rules lead to confidence. Now, does it numerically make sense? In many cases, yes. I think it's nearly impossible to beat a great buy and hold selection over 20 or 30 years, but you can beat a lot of things with just a quantitative rules-based approach. So I like stats. I like numbers. I like rules. I like to be out when the drawdown hits. And if you don't like the losing, that's where a rule-based or a quant-based approach really pays off. So in other words, do what you like. If you like holding, if you like having reasons and reading fundamentals that way, then you got to invest. It's better for you. There isn't one way better than the other. But for me, I just want to be out when the stock is supposedly going to go down. That's what helps me.
So let's kind of talk about that, when the stock is is going to go down, kind of, guys, what are your exit kind of strategies? Like, you're not holding it for life. At some point you get out. Maybe, there could be a variety of reasons of getting out, but let's talk about an exit. Like, hey, now the stock, after all these years, is behaving a certain way, and I think it's time to go to the sidelines on that stock or that sector or that sort of thing. What are some tips or ideas that make you come to that conclusion on a particular stock or sector or whatever? Let's get started with you, Jack. You answer that for us first.
Don't sell it.
Don't sell it.
I mean, here's the thing about it. I love dividend stocks, right? Now, Coca-Cola could go to $10. It's still going to pay the dividend. So here's what I tell people, like Scott was talking about, you don't want to see the losses. When you look at your portfolio of dividend stocks, go to investment income before you look at your P&L, because the red and the green is going to make you all emotional, right? But if you just focus on how much is this portfolio throwing off in cash every month, you're going to be happy. I got it on my phone when the dividend comes in. Like the other day, it says J&J is paying you X amount today. I never get tired of seeing that on my iPhone, right? So that's what it's about, the investment income, not the gain or the loss, right? So hang on to it, reinvest the dividend, sell calls on it, and buy more of the same stock. Let time do the heavy lifting.
There you go.
Now, one thing like 3M, that's a dying business. If you look at a chart and it's down 5 years, you want out of that. You read all the headlines. That would be one exception, but I wouldn't buy junk like that to begin with. So, yeah, I don't sell. Look at McDonald's. That was the best example I can give my son. Somebody said one time, a portfolio is like a bar of soap. The more you handle it, the smaller it gets.
That's a good way to put that.
Don't sell.
There's a lot of hamburgers that he was able to buy with those profits too on McDonald's. So good for him. Garrett, how about you? How would you answer that question? How would you decide that you're going to part ways with a stock?
I like Jack's answer about McDonald's because my daughter, I started buying her shares of Berkshire B shares, and I buy her one a year. And the thing about Berkshire is what people think that Buffett's this, really smart value investor. He actually invests in monopolies.
Mm-hmm.
If you look at what Berkshire owns, they're very monopolistic, whether it's DaVita, which is like 95% of all dialysis, and he owns all the big credit card companies. So that's one thing. But for me, I care about the business. The one thing that matters to me with a long-term investment is whether or not their board of directors is actually interested in making money for me anymore. And it's very easy for us to sit here and like pick on companies like Bud Light and Anheuser-Busch and Target and, some of the recent news. That's kind of the qualitative story of, they're turning their back on their core customer and some of the things that, don't worry about that. Focus on the F-score. Because if the F-score is dropping, if the F-score goes from a 9, which shows very strong capital discipline, and now this company is now running in the 1s and 2s, there's something wrong. And that might be they're just taking on too much debt, or maybe they're issuing shares illogically within the business. These are red flags that you have to pay very close attention to. I watched what's known as the Benesh M score. That's to kind of determine whether or not a company is manipulating their balance sheet. These things matter because that type of stuff was happening before AMC became a problem. There was a time we all thought, well, movie theaters aren't going to go away. That what a great business that is. But then once they started to get disrupted, that's one issue. Jack talked about that with 3M. Then they start to engage in these weird patterns where they start to effectively know when the empire is crumbling, the first thing that people do is raid the treasury. And you start to see this start to happen. And whether it's AMC or whether it's, companies like Enron or companies like, go back many, many years, you can see manipulation in the balance sheet if you know how to analyze it. So when those readings start to go in the opposite direction, I get a little bit of a red flag, and I'll think to myself, yeah, maybe I need to allocate this to a different sector, or maybe I need to understand if there's disruption coming down the pipeline. I do always go back, though, that you can't really do badly if you just focus on trends that never go away. Jeff Bezos was asked all the time, what are you going to disrupt 10 years from now? And he effectively said, why don't you focus on stuff that was working 10 years ago and works today? Because that's going to work 10 years from now. So that brings in food and military and oil and gas and electricity and all the demographics and population. That stuff's not going to go away. So if you find a company like ABBV, which I really like, it's another company I had for my daughter's portfolio, long-term, healthcare type of issues involving things that are I'm blanking on the exact term, but I have arthritis. So, kind of these like life maintenance drugs, that's not going away anytime soon. So, so long as the F score looks good, so long as management's doing what they're doing, so long as they're improving their pipelines, I'm good. I don't have to worry about it. But if I start to notice something a little hinky in the way that they're managing their balance sheet 2-3 years from now, yeah, maybe I'll move over to a rival.
Yeah, great. And some people are asking, how can they where could they go to see these ratings?
So the F score, you can see it on Stock Rover. You can get it on Guru Focus, or you can just type in the stock that you own, and you can type in F score in Google, and it should take you to the Guru Focus version. There are 9 points on the balance sheet. I encourage you just to read about it. The core things are they increasing their return on assets? Are they reducing their leverage? Are they buying back stock? I mean, all of these things are very, very focused on shareholder discipline. And this is what energy companies have done so well over the last 5 years of just not drilling, not overexpanding, being capital discipline oriented. And now, right now, this period of time, we are reaping the benefits of that type of discipline.
Exactly. Well said. Very well said. So, and we're going to talk about some short-term trading, everybody. So no worries on that, but we're going to get there here in just a second, using this kind of approach so that maybe it will help give you an edge on your shorter-term trading. But before we do that, Scott, which one of your favorite ways to say, okay, time to part ways on this stock?
Well, first of all, the losing part is not dividend stocks. I mean, Jack hit it perfectly. If you're talking about dividend stocks and stocks that are bringing in money, I changed my answer, and we're going to maybe talk about some dividend stocks in a second.
Yes,
if something's bringing you money and paying you, maybe you don't care about the losing the stock going down. But if we're trading a stock and going for growth, or a stock that could potentially go to zero or go up a couple 100%, then yeah, I definitely need a rule, and I definitely want to stay away from the losing. And for me, it's pretty simple. I'm a quant trader, so I like to build quant models and algos and all those sort of things. And I've built some complicated ones all the way down to the 5-minute chart, spent thousands of dollars trying to get just the right exit. And what I've found, especially in stocks, is that you can be super simple if you go out far enough. If you go out to, for example, a monthly chart, you don't need complicated exit points. So for me, it's real easy. And I've put this type of trading on every big winner that I can find. I mean, I've looked at dozens and dozens by now, and it's my little hobby. But I'm looking at all the big winners of stocks, like the Amazons, the Apples, and a very simple, just a break below a simple moving average gets you out in a reasonable time. It gets you out. It's not perfect. You're going to give back some gains, but just getting out on, now you have to be on a long-term chart. Otherwise you'll get whipsawed like crazy. But for me, long-term chart and a simple moving average is wonderful.
Excellent. Great. Okay. Well, let's take our eye over here to this Forbes article and just kind of looking at some of the stocks that they were, that he was writing about. And I mean, most of these, I've actually heard you say a lot of these already, like Johnson & Johnson. We've talked about Amazon. I know NVIDIA is hot on people's list, Tesla. And even 3M, is down there. And actually, when I saw that down there, Jack, I kind of laughed out loud. I'm like, well, first, I haven't traded AT&T personally a lot, but I don't think I personally don't want to own Walgreens, and I don't want to own 3M. They just, if I'm going, I just am not wanting to own those. So so I don't know. We'll talk about it. But what I want to do next is kind of look at this list. There's all those that they're kind of suggesting, dividend stocks, value stocks, growth stocks. So as a starting point, have any of these tickers been, stocks that you have traded on the short term that it's been helpful that you've had a longer term understanding of them that has really helped you with your short term trading? So let's start with you this time, Scott. You can get us started.
It's funny because I do watch stuff every day, and I am very short term like everyone else. I'm watching the market literally every day, and I'm reading about it literally every day. But it's so easy to get swept up in the magnetic pull of, oh geez, that news event or this news event or the Fed's going to do this. It's so easy to get trapped in that. So for me to trade short term, to make a decision today, I would have to look at several years back. I would have to look at how it's set up on my chart. I'd have to look at the simple indicators I have on my chart. and I'd have to have a reasonable expectation. You know, Garrett said, how do you predict the next 10 years? Well, look at the past 10 years. So I would do just that. And so I would make a decision that probably wouldn't be reversed, right? I'm probably in my position for a number of months. But if I'm going to make a position today, then I just look at my setup. I look at the history. I look at what I can reasonably expect out of this move. What has it done in the past when it's looked the same? And then I have no problems pulling the trigger, because I am thinking, well, you know, this is going to be my decision probably for the next 8 or 9 months or so.
Yeah, excellent. Great. Thanks for that. Jack, how would you answer that question?
Well, for the I wouldn't make it. My time horizon on a trade is like 2 to 10 days, and I don't trade the dividend stocks. I just buy and hold. No AT&T. These are dividend traps. AT&T, Walgreens, Boots Alliance, and 3M. Those are all dividend traps. But the other stocks are I don't know what is a value stock, but I love Johnson and Johnson and ExxonMobil. And the growth stocks, if one of the things you could do with those, I like to do, is use that as an asset to create an income trade.
Exactly.
Right. Even though the stock's on a growth stock, I still think it's hard to directionally trade individual stocks. It's way easier to take a growth stock like AVGO, which is an awesome dividend stock, or NVIDIA, and for me, just to use that as an asset to create an income trade for the week.
Excellent. Yep. That's great. That's great. Well said. How about you, Garrett? What's your response to that question?
Oh boy, this is where I get on my soapbox, right? This
Get
is where
on
I
it,
point.
get on
This is
it. I
where
love it.
this is where I point out that the markets since 2012 are largely an illusion, and that global finance has been completely disrupted and destroyed, and that we are not in the business of financing anything anymore. We are in the business of refinancing debt. So that is why we focus heavily on liquidity using the old Salomon Brothers model. We focus on momentum. And what we see is that capital moves markets. So when you see expansions in liquidity in the system, whether it's central banks or shadow banks or cross-border capital, that is ultimately what is leading to these markets moving higher and lower in any given point. And we don't know why momentum goes negative at times, but it does. March 7th was a perfect example. It went negative. We got out of the way. We started to short. We bought the SQQQ. And if you Google regional banking crisis in March 7th or before, nothing comes up. 7 days later, it was the only story that we knew. So there was a liquidity issue in the market. The same thing happened last year in June. It happened in September. It happened in December. That is unusual to us because typically we've just seen balance sheet expansion for 12 years. But now with interest rates rising, with a lot of zombie stocks under pressure, I hate to say it. I mean, when we look at fundamentals, I think the only stocks that you really want to trade if you are a conservative trader, you want to see liquidity expanding, you want to see momentum expanding, you want to see insider buying if it's possible, and you want to see EPS growth and strong F scores, strong Z scores, low EV to EBIT. That's a good definition of a value stock. But I swear to you that when the central bank of Japan or of China just decides to expand its liquidity and just starts dropping money from the sky, that's how you have a company like Carvana go from $4 to $18 in a month and a half. That's how you have a company like Carvana go from 16 to 58 in 3.5 weeks. Liquidity, capital drives the markets, and literally fundamentals are out the window on a lot of the high short interest stocks.
Okay, that's great. So great input, and you said a lot in there too. Just with the whole liquidity thing, the up and down movement of the overall broad markets. Your thesis, and which is brilliant and wonderful, with that really impacting the ups and the downs, and using your momentum indicators there for getting in and out. So Garrett, let me start with you on this question to kind of looking mostly at the growth and a value type of approach. So, and maybe let's, maybe the first starting point is for us just to kind of, define kind of what would be a value stock, what would be a growth stock, and then how would you approach? Would you tend more towards a value stock or a growth stock when using your liquidity pullback, and any of us have these pullbacks, whether it's pulling back to the 50-day or pulling back to the 200, and this seasonality or that cycle or whatever. When we get a pullback like we're having right now. Okay. Sure. We're having this pullback right now. So, you kind of got these they're listing ExxonMobil, J&J, Verizon as kind of value stocks. We've got the big big names, the Nvidia, Amazon, Tesla, the growth stocks. How do you look at the next stocks you're going to trade, whether it's for the long term or the short term, on this pullback right now that we're having? That, maybe there's some things I'm looking at the long term, maybe there's some things I'm looking at a short term trade. How do you use that kind of growth or value stocks? Which kind of stocks are you going to kind of pick at that bottom kind of turn to get into?
100%. So within the realm of momentum in which I view the market, and that is really a measurement of capital in, capital out. It's not that complicated to do. You can do it with a FinViz account, but it's really an analysis of the stocks that are breaking out versus the number that are breaking down. These are effectively anomalies or outliers in the market. That reading does not miss. It is based on Antonacci. It's based on Grant Henning. It's based on a lot of people like Wes Gray. It doesn't miss. It's been right since 2015. So when this thing goes red, we move to cash. Even if it's 2 days, if you're trading, just get out of the way. You don't know what's coming. But when it goes green, it goes green. So within the realm of value, you're looking for companies with good balance sheets, good F scores, good Z scores, so that there's no credit event. They're going to be in trouble. I don't pay attention to price to equity or price to earnings ratio. I pay attention to EV to EBIT, earnings, enterprise value to EBIT. I'm looking for stocks under 7, under 8. And right now, what you find is it's companies that make stuff, companies that make real things with strong demographic things behind them. So, shipping companies are cheap right now. Danios Corporation, Global Shipping Lease is cheap. Uranium stocks are cheap. Downstream energy is cheap. Even some of the housing stocks, people will think that they're not because they're up 100%. They still are historically cheap, and they certainly are. There's a lot of names that are cheap compared to their peers. And then I really, really like, the midstream. There's a lot of shipping container companies that are in that space as well. Some of the banks are cheap. I'm going to get away from that. But, fossil fuel exploration, one of my favorite names. And I view this as a value stock because I have a 7-year horizon on it. And I think it's going to go up 400%. It's Crescent Energy, CRGY. This is a KKR-backed company with a 9 of the F score, dirt cheap metrics, and all they're going to do during this period in the next couple of years is buy distressed assets and then turn them into cash flow machines. This is backed by KKR, the best private equity company in the world at the leverage buyout and energy side. And they're kind of moving through their J curve right now. The stock went from 15 down to 9. It's moved back up to about 13. It's going to chop along the way, but I look at it and I say, I'm going to go long on this. As long as energy momentum remains positive, I'm in. If energy momentum moves negative and we have a big sell-off like we've seen June 8th of last year, March of this year, then maybe I'll cut some of it, but I'm going to look to add more to this position over time. Because I firmly believe that this is a company that has the possibility to be, a big tier oil company in the United States 4 to 5 years from now. And at $13-14, I'm in because I think it's going to 60.
Yeah, lots of opportunities to make money on that analysis in the short term and long term, right? Great, excellent. So Jack, let's move on to you. How about you? Thinking about this pullback that we're having now, growth stocks, value stocks, what's your approach to getting in, getting long, finding stocks? What do you think?
Yeah, once I find a trend, which is my thing, I stay on it like stink on a monkey. I'll go back to that stock over and over every week and put on my credit spread, and I'll use that growth stock as an asset to create income. I'm not really interested in buying a stock at 16 to go to 60. Because I'm not as smart as Garrett. I can't do the fundamental research. I can't read anything for more than 10 minutes. So I got to keep it. I'm the Homer Simpson of the trading world, So if I find this, if I'm finding stocks, if I already got a stock in a trend, I'm all over it. I'm going to stay with it. If I'm looking for a new stock, I start with a stock that's hit a new 52-week high. And, again, my time horizon is 2 to 10 days, and I want to move on. I don't know how to define a value stock or find that, but like with the just straight up dividend stocks, ExxonMobil, I love it. I just buy more of those things, Johnson & Johnson. I just buy more of it every month, and I don't trade it. I just I'm buying and holding it. So I got the bulk of my money in that buy and hold thing, and then I got my my wildcat account that I do what I want. And And that just works out great. It's much smaller on the Wildcat account. You know, the bulk of it is, like I say, I just love getting dividend income.
Yeah.
How great would it be to have corporate America pay you every month or every quarter, and you live on that?
Yeah. We're going to talk about that. We got a great segment coming up on corporate America paying you some dividends. So hang on, guys. You're going to be blown away. You're going to love this. And you don't have to get your wallet out today at all. So put your credit card back. You do not need it today at all. You're going to love what you're going to get. So hang on just a second. All right. So Scott, what's your kind of answer to that question? Entering, looking at value and growth. And the whole reason we bring this to everybody, because we know that these are the typical headlines. Forbes is a very common magazine. A lot of people read it. They live by it. So let's analyze it. And that's kind of why we're doing that. So what's your approach? What's your thoughts, Scott?
Yeah, well, first of all, Jack's right. I don't think anyone's as smart as Garrett, just getting to know him a little bit in these sessions. So for sure, listen to Garrett. But as far as value stocks, there's a couple of real easy ways to do it. And one of them is embarrassingly easy, but it's something that people can take a look at. And that is, you can go to, Seeking Alpha. There are places, look at the dividend history, look at the yield history. And simply when the yield is lower, or the yield is lower than it's been in 5 years, then that's bad, right? The stock has probably gone up, so that's overbought. And if the yield is way higher than it's been the last 5 or 10 years, you can buy it at that point. Like that little buying and selling on the yield range, test it out for yourself. It's ridiculous that it works. Not every time, of course. So that's one little tip. There's another tip. You can go to magicformulainvesting.com, Joel Greenblatt's book, the little book that beats the market, little book that still beats the market. He made a free screen that you can go to that's made exactly for value stocks, quote unquote, and you can get a nice list there. I've used that resource since 2006. So that's a good place to start. However, for me, if we're talking value first, I don't mind the garbage. I'm not going to buy and hold it, but something like MMM, or, look at TUP, Tupperware, or even GME and AMC and those ridiculous, or BBBY, Bed Bath, these garbage things that are going to be gone tomorrow. I mean, they can actually trend before they're gone tomorrow, right? So I don't mind putting them on my list, but value to me is long-term chart. Number one, get on a monthly chart. I get my simple moving average, my 12-month simple moving average, get that on my chart. And I want to see it do the Weinstein pattern that I've talked about before, and maybe we can talk about in a little bit. But I want to see it go through stage 1, stage 2, stage 3, and then fall all the way down to stage 4 and just die down there. So it makes this little curve, and then it's just dying, and it's nothing. I love to put those on my watch list because either A, they're just going to sit there and never break above the moving average, and I ignore them forever, and they go to 0 and goodbye. Or they break above, they give me a trigger, and sometimes you get these stupid moves that I just chuckle at the whole way, but they move. And if it moves, it moves. It's fine for me. So I would put a scan on, say, the Dow stocks, state names that or the S&P 500 stocks. And I would just run a scan and say, has it gone through all the stages? Is it way down below the simple moving average? And then I just put them on a watch list. For me, it's a great way to find value, whatever that means. As far as growth, my real easy solution to that is twofold. Number one, has it gone up crazy before? I mean, that's it. Do you see a 100% move recently or anywhere on your chart? Then that's probably a growth stock. And the other one is I love trading IPOs. And I've talked about that a couple times on these sessions. Look at IPOs. IPOs can go nutty and we don't even know what they do. I don't even know what their earnings are. But you can trade those with a pattern, with an entry and an exit, and you can get some accidental growth. You don't even know what's going on. So those are the things I look at.
And you got a great IPO coming up on the 14th. ARM.
ARM?
Going to be a monster.
Oh, darn it. I'm going to have to leave. I'm to look at this. Can I come back in about 5 or 10?
No, we're all like, what's the symbol?
Well, this is going to be amazing. We could have a whole talk on ARM.
ARM.
Now's not the time to do it, but this is a way different type of IPO, and it could kind of unlock the backlog of companies trying to go public. But
look at that, Jack. Oh my goodness.
Ooh,
all
right.
And I'm going to tell you one more thing about this one. It's the weirdest IPO I've seen in the sense that they have all their partners and competitors in on the deal. Google, Apple, Samsung, Advanced Micro Devices. They're even NVIDIA. They're all the buyers of they're funding this first piece.
Right.
It's so instead of billionaires getting in early on this IPO, it's their competitors and partners. It's going to be a wild thing.
Interesting. That is, that'll be a great discussion. All right. Well, let's kind of segue now into these dividend stocks. And Scott, I'm going to have you go ahead and you can take over the screen at, whenever you want. We've talked about, some people have mentioned, their kind of favorite dividend stocks. And let's just kind of hone in on this. Let's find out a little bit more. Scott has something prepared that's just spectacular. So take it away.
Hey, couldn't find my share button, but now I found it.
There it is. You got it.
Is that okay? Or should I do it bigger?
It looks great.
Okay. Well, we're going to talk about, and I take credit for none of this. I'm just piggybacking on what smart people do. So
that's what we do.
Yep. So we're going to talk about what billionaires. I am going to talk about some numbers, so don't risk any money, cannot afford to lose. And okay, enough. Now, don't always have to reinvent the wheel. As you get older and you hopefully get wiser, you realize you don't have to make the new iPod or the new whatever. You don't have to reinvent the wheel or invent fire. Sometimes you can just copy or take the great ideas from giants, right? Stand on the shoulders of giants and just kind of enjoy the view. For example, I'm a high performance tennis coach, and Roger Federer is the greatest athlete of all time ever. And I will not hear anyone say anything otherwise ever either. So there'll be a fist fight if anybody disagrees with me. But anyway, you don't have to become the best tennis player of all time. You don't have to make up new strokes. There is actually a highly ranked junior who just recorded Roger Federer thousands of hours, took no lessons, just copied his strokes and made it to top 10 in the country. Wow. Right? So you don't have to necessarily, even in tennis, you don't even have to make up something new. You can make up something that's a giant has already done, right? You can just follow along. This is a headline. I love these headlines. I like to keep these. This is from this week. We got a crash coming, everybody. I mean, honestly. But if there is something coming, of course, we're looking good today for a minute. At least we were when we got on. But if something bad is coming, okay, what are the billionaires doing? Like, what am I supposed to do if this crash comes and everything goes to Hades, right? Well, we could WWBD. Like, what would a billionaire do, right? Now, for my money, again, this one I am argue. I won't argue Federer, but I think this is the greatest trader of all time, Jim Simons. I mean, he's about 3 to 4 times better than Buffett. He hasn't been trading as long, but I mean, Simons is the best. He's the GOAT as far as I'm concerned. And what's interesting about Jim Simons? He's a quant guy, right? We don't know really what he does. You read all the books, he doesn't give anything away, but he claims that it's all robots, right? It's all software. Again, who knows? But after he's made billions, right? I think he's worth over 20 billion now. He is doing something very strange for a quant that's made billions. He's buying dividend stocks, right? And you can look this on the internet. That's out there. Jim Simons bought in a Renaissance, bought this. And how curious, right? If something's going bad, billionaires are buying stocks that pay big dividends. I thought that was very strange. Or maybe we don't have to have any original ideas. Here's a list I stole from Forbes. So funny, Celeste, that you said Forbes today. But this is from Forbes. Again, don't take Forbes' word for it. Don't take my word for it. Look it up for yourself. But here are a handful of stocks that billionaires are buying, right? So first one up, and I'll go through them quick, but Pico is one. There's the yield up there. Not as good as you can get in some of the money markets, blah, 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 but still way better than the average. And here are some of the guys that have bought in the last year or so. Ken Fisher, famous billionaire. Ken Griffin, famous billionaire. Oh, Jim Simons, there he is. And Clifford Asness, right? These are guys who have made billions trading, but yet they're buying this dividend stock, right? And if you want to know what it is, it's shopping centers that have grocery stores in it, okay? So there's one, Pico. Here's another one, Stag. Yield is 4.04. I updated this yesterday, so it should be about that. And there Steve Cohen. He must have some inside information about, that's me. I shouldn't say that, but Israel, Clifford Asness, who just distribution centers, Amazon type of places, right? So Stag, okay. Another one, ADC, yields getting higher as we go. They're your billionaires. Jim Simons again, Steve Cohen, Ray Dalio, very famous billionaire. Properties with national names like Walmart, Tractor, right? So these will probably be around, right? So that's what ADC does, right? Again, I'm not disputing the merits. These aren't my ideas. But this might be the star of the show, as we'll see in an upcoming slide. Yield is getting higher. There's Ray Dalio and Simons and Asness and Englander again. 13,000 retail, industrial, and agricultural properties, right? In all 50 states. And Realty Income, pun intended, has raised dividends for over 50 years. That's interesting, right? That's fairly consistent, like we talked about earlier. Here's LTC. Again, the billionaires are buying, according to Forbes. 7% dividend. We're getting up there now. Simons, Griffin, whatever. Senior housing, right? We're probably going to always need senior housing. I mean, I get with these billionaires. I get what they're laying down. I mean, that probably makes sense to me, right? And last one, EPR. We're up 7.46. Again, the usual cast of characters. Specialty properties and entertainment, education, and recreation. We got golf. We got ski parks. We got all sorts of things, right? AMC theaters. Woohoo, right? Well, it's their idea. It's not my idea.
Yep.
All right. So those are a handful of names that you can go look up, make sure the billionaires are buying it, not selling it, right? Confirm for yourself. But why are they buying this stuff? And is it a good idea? Well, we could break it down or have Garrett break it down for us. That would be awesome.
Garrett.
Or we could just look at this. And this is just a little comparison. Now, this is a comparison of Pico and SPY, right? And this is with dividends reinvested. So why are the billionaires buying it? Well, let's see what the numbers say. Pico's only been around a little bit, right? But the average total return is 14%, and the market in the form of SPY is only 2%. So since 2021, and sorry, I couldn't make that slide easily readable, but trust me, you can see that Pico is the black and that's the SPY. Over here is TradingView. The colored bars are the stock Pico, and orange will always be SPY. So what's interesting about this is Pico has beaten it without dividends reinvested. Like it just beat the SPY straight up on the chart. This chart is no dividends reinvested. This is dividends reinvested. So maybe the billionaires like that it beats the market and it pays. Here's Stag. Since 2011, it goes back a little farther. Average return 15 to 12. Just on the chart, you can see it's a little bit behind. It's a little bit behind. But when you add the dividends back in, well, it beats it. So maybe that's why they like Stag, perhaps. Here's ADC. This goes back. It's been around for a while, which maybe you like that. 12% to 9%, which over time you can see makes a whole lot of money. But just price action, all that time, ADC's been beating the SPY. Just buy and hold. No special entry techniques, no nothing. It's beat it straight up, right in your face, SPY, right? And then, of course, you get the dividends on top of all that, right? And there's, the star of the show. 12 to 9 since 96 again. I mean, it's just destroyed it, right? And plus, it pays a nice dividend. Right? Go ahead.
Monthly dividend, by the way.
Oh, yeah, exactly. That's right, Jack.
LTC and pay monthly dividend, just saying.
Yeah, and monthly dividends are the best, by the way. Yep. I love that. Here's LTC, beating the market overall, beating it with the dividends reinvested, right? And EPR, beating it straight up, right? And then beating it with dividends reinvested. So isn't it interesting that all three are being accumulated by billionaires and all three beat the market, almost all of them by themselves? And if you take Jack's idea of taking those dividends and keep cranking them back in, I mean, we don't have to come up with great ideas. We can just kind of follow along. So I can go into a few other things, or I can turn it back over to you, Celeste. What do you think?
Well, you can, we've got some time, if you want to go over a couple other things and keep going. I typed all those symbols into the chat, so y'all can grab those there, and just letting you know too, the recording will be available. And so when they post it to the atptraders.com website, you'll be able to re-listen to a lot of this, a lot of great stuff. But type in too, just before he gets started, what do you think, guys? I mean, has this been valuable? Did you like some of the content that you've received? Because what I just heard you say, Scott, it's just over and over and over. When you get familiar with these names, you've all said this, it's just, then you don't have to do so much work. It actually feels a little easier because you already know about the company, you already know, hey, I can jump in and make some extra bucks with this option, or, oh, I can, make some extra money with these dividends because they're paying dividends right now. You just use that knowledge to make money. That's why we're all here. We all want to make money. So how can we use this knowledge to make money? Hopefully you've gotten some tips on that. So thanks for typing that in. Love that. Thanks everybody for typing in. All right, keep going, Scott.
All right, a couple more. Since we did talk about growth too, I'll finish with that. Or you can not take any of these ideas. And I mentioned this before, and I wanted to clear something up for sure. This is just third-party software. I didn't create the software. It's just a fun little tool. It's a dividend reinvestment calculator. That's all it is. But if you don't want to pick anything, this is a great option. The VIG, going back to 2006, you can see it matches the SPY, but it's got a higher dividend, right? Now, of course, the dividend yield depends, on how it goes down, blah, 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 but it's higher than the SPY. So if you could just take this, match the SPY, and you would get a little bit more for your money. So if you really want to dumb it down and don't want to follow the billionaires, you could even go to VIG. I had software that when I looked at this initially, VIG did better than the SPY, and it just matches it. And you can see that over here on my chart. You can see, they're just dead even, right? VIG beats it in bear markets, but overall it just kind of follows along, but you get a little more bang for your buck. So I do love VIG, but that's only if you don't want to follow the billionaires. You just want to say, listen, I'm just going to set it and forget it. And that's an ETF that pays you a little bit more and it matches the market. So I'll finish with, we talked about growth, so I'll finish with this. Stage 4, I'm looking at, I want to literally see this on my screen if we're switching gears to growth stocks. So it explodes, it goes sideways, it falls down, and then right in here, right? Stage 4, getting right back into stage 1. I want to see all this. So a value pick that might turn into a growth pick, I want it to literally look like this. Okay, everybody clear? And stocks do this over and over and over again since the beginning of time. Okay,
over multiple time frames, by the way.
Yeah,
too,
yeah, 100%. Yeah, I'm looking at crazy monthly, but yes, all over the time frame. This is a stock that IBD loves. It's got increase in sales over the last quarter, increase of EPS over the last quarter. It shows relative strength over the past 3 months, like everything that William O'Neill loved. And it's an IPO because it's brand new. This is Grab, and you can see the moving average just showed up not that long ago, and it's fallen down into that stage 4, stage 1. I kind of like that in my perverse, crazy mind. I like that. And then you could buy, it's already triggered with 2 closes above the average, but you can buy or at least take a look above 392. Could it get to 16 again? Nobody knows, right? But this is the kind of thing I love. It comes down into stage 4. It's a new stock. It's got good earnings. It's got good sales, and maybe we get a breakout. So I'm watching this personally very close. And then this is ridiculous. This is an embarrassment. BlackBerry, right? What year is it? 2007, right? Yeah. But BlackBerry can go. It's one of those trashy, forgotten about, ridiculous stocks that can go. Look at this.
You can make money on it.
I know but it's just, it feels funny saying my BlackBerry. Like, who has that? But look, it's done the pattern, and it's gone sideways above 575. I'm going to consider it. I'm going to have a conversation with myself and say, do you really want to have a 2006, 2007 stock that's not popular anymore? But gosh darn it, this thing could go. So those are 2 possible growth picks that we can look at too, besides the billionaires.
Excellent. Let us know. You'll have to let us know. Well, great. Thank you. That was fantastic. Great content. Thank you, everybody. Wonderful information shared by all. So any last words, Jack, comments on today's session?
Yeah, it's great. Dividends are one of my favorite things. And one of the reasons these billionaires are buying them that Scott might have left out is the taxes. It's the lowest taxed income you can get. And for a billionaire, they're going to want to pay that 15% on a qualified dividend. And the price, they're going to make a gain on the price. But again, if you got the right dividend stock, like, Coca-Cola, it's maybe $60, $55. It could go to $10. It's still going to pay the dividend. So that's all I got for you.
That tax is a huge point, Jack. That's an awesome point. Yeah, I didn't say that. Awesome point.
Yeah, we love to save money. We love to make money and save money. It's funny how that is. Garrett, last words, comments on today's session.
Jack said the smartest thing of all. I can't top that. That's exactly the point, right? It's all about tax. It's about reducing your tax liability. And that's what these guys are doing. They're smart. They understand that, when it comes to REITs or when it comes to different types of, tax structures that exist out there, whether it's within pipeline businesses or within real estate, or those tax advantages exist and a lot of people don't know about them. So it's awesome to, to get an opportunity to listen to somebody talk about this. Scott, thank you so much. It was great insight.
Yeah, great. Well, the whole session was just fantastic. Just the whole bringing, usually we talk kind of small picture, because we're doing the short-term trading, but it's from time to time, it's really handy to go from that big picture down, get perspective, understand, because even during these pullbacks that we've been having recently, just having knowledge on what you want to get in, because you want to buy, you just want to be knowledgeable of what you're going to get in on. So we're going to find out in future sessions if Scott actually did buy BB BlackBerry. And so stay tuned. Yes. And very exciting session. So last words too from you, Scott. What did you think about the whole session here? Was it?
No, it's so much fun to be here, and always get such great ideas, and you always get smarter. So I'm always happy to be here. Be here anytime.
Gary says, hey, the portfolio like a bar of soap is really great advice too.
Yeah, that's hilarious.
That's really good. We had some really good one-liners here today. So anyway, well, I hope that made your day a little bit brighter and your week a little bit brighter as well, and that you're able to take this knowledge with you through the weekend and use it here in this month of September and October as some great opportunities are setting up. I think that's kind of what we're hearing here today too. So thanks everyone. Thanks Jax. Thanks Garrett. Thanks Scott for joining us. Everybody have a great weekend.
Yeah. Adios, amigos.
Adios. Oh, shoot. We forgot to say that Roger Scott is live. I meant to say that, just got carried away. So you want to make sure you join him. He's really got some amazing setups. You got to go find this out. The link is in the chat. Go there, go get it now. You know how much we all love Roger. And whenever that guy opens his mouth, we want to listen. He knows his stuff. And boy, this is really awesome. You're going to want to see it. We talked about Amazon today. He's going to be talking about Amazon. Go check it out. Might make some money. Thanks, everyone. Hey, Jim, if you're still in the room, if you could, type in, let me know the answer to that question. I got your comment there, and we'll make sure that we get that passed on. So thank you for letting us know.